This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Welcome to Escala Investment Perspectives. While June is often what we describe as the tax month, where portfolios are rejigged to realise tax losses and maximise super contributions, July is often a time to reflect on strategy for the financial year ahead, where to commit capital and where to trim back. And for Australian investors, the two main issues to consider now are the AI trade and government policy, both of which are transforming the investment landscape. So today we'll delve into these issues. And of course, to provide the insights is our Chief Investment Officer, Tracey McNaughton. Welcome, Tracey.
Hello, Ed.
Now, Tracey, one of the questions I'm hearing more and more from clients is whether we're in a bubble. Markets continue to reach new highs, and enthusiasm around artificial intelligence remains extraordinary, and valuations are elevated in parts of the market. So what do you think? What are you saying to clients?
Well, I think it's a very fair question. When we think about bubbles, we often think about periods like the dot-com boom or the boom in Japanese equities in the late 1980s, where prices became completely detached from economic reality. At the peak, the Nikkei was trading at 60 times earnings. That meant investors were willing to pay 60 years worth of current earnings for many companies. That's not where we are today. The US equity market is trading on 25 times earnings. I think the point is this is a technology revolution, and that revolution spills over into many industries. It has many layers to it. And what's good about it is the center of gravity keeps shifting. 2 years ago, the market was almost entirely focused on the AI model builders and the hyperscalers like Microsoft. Then it moved to semiconductors. More recently, we've seen leadership broaden into memory, networking, power infrastructure, electrical equipment, data centers, and even utilities. As each part of the AI value chain becomes fully valued, the market has tended to rotate towards the next bottleneck rather than simply pushing the same group of stocks ever higher. And so in that sense, it's almost been self-correcting. One part of the AI ecosystem pauses, another takes over, and leadership broadens rather than simply becoming more expensive. If you think about, you mentioned end of quarter, if we think about what happened to tech stocks in the second quarter, relatively unknown memory stocks like SK Hynix in Korea surged over 200% in the quarter. In contrast, a hyperscaler like Microsoft rose just 1% in the quarter. This rotation is keeping valuations in check. The forward price to earnings multiple for Microsoft is around 25 times. Even for Nvidia, which is the poster child for AI, is trading on 23 times earnings. That's certainly not cheap, but it's also a long way from the valuation excesses we saw during the dot-com era. So I don't think we're in a classic valuation bubble. I think we're in a market with very high expectations, and I think that's a different risk altogether.
I see those high expectations tend to be a feature of a mature cycle. Is that more the issue?
Well, bull markets don't last forever, we know that, and they don't tend to die of old age. They do evolve, though. Earlier in the cycle, investors are mainly focused on growth, but as the cycle matures, the issue changes. It becomes more about focusing on inflation. And that's exactly what we'd expect to see as we move into the later stages of the cycle. Growth is no longer the binding constraint. Inflation is. And because inflation determines what central banks do, it increasingly determines what value investors place on future earnings. The higher that interest rates are, the less value is placed on future earnings. So even though we're likely to see some pretty extraordinary earnings from many US companies during this current reporting season, we may see a more muted response to them by the market.
So that actually creates a really interesting backdrop for what we've seen from the government this week. We've just been talking about markets becoming much more focused on inflation and the prospect of interest rates staying high for longer. And at exactly the same time, governments are trying to solve some very big structural challenges. They want more housing, more electricity infrastructure, greater AI capability, and above all, stronger productivity. And all of that requires enormous amounts of investment. We touched on this in our last podcast when we asked who would fund the next wave of nation building. And interestingly, that discussion came to life this week in two different ways. The first was the Prime Minister's new AI strategy, and the second was the debate around whether Australia's superannuation system should play a bigger role in funding nation-building projects.
Yeah, and on the AI, I actually thought the Prime Minister made an important observation when he said Australia shouldn't simply become a data warehouse for somebody else's AI. That's exactly the challenge that we discussed last time. It's not enough to attract investment. The investment also needs to leave Australia better off. And that's why the government is proposing that large AI data centres contribute to the electricity system they rely on, create lasting employment opportunities, and ensure Australian copyright holders share in the value created by AI. Conceptually, I think that's exactly the right objective. It's aligning who pays, who benefits, and who bears the cost. This is really an attempt to create that alignment, I think. But there is a balancing act. Every additional requirement also changes the economics of investing in Australia. Private capital is incredibly mobile. A global investor can choose to build AI infrastructure in Sydney, Texas, India, Malaysia, wherever. Ultimately, that capital will flow towards the jurisdictions offering the best return for the risk that they take. So I think the challenge, for the government is becoming increasingly clear here. How do you make sure that Australians share in the benefits of AI without making Australia a less attractive place to invest? That second example this week that you mentioned was the discussion around Australia's superannuation system. And the Prime Minister described Australia's super pool as a national asset that could help fund Australia's future. Again, I understand the thinking. Super represents one of the largest pools of long-term patient capital in the world, actually. It's exactly the type of capital that long-term infrastructure and nation-building projects require. But Anthony Miller from Westpac made what I think is the equally important point. Superannuation doesn't belong to governments. It belongs to members. Trustees have one overriding obligation: to invest in the best interests of those members. I actually don't think those two positions are incompatible. In fact, the ideal outcome is where they're perfectly aligned. If investing in Australia's infrastructure, energy, AI, or housing delivers the best long-term risk-adjusted returns for members, then everybody wins. Members would receive better retirement outcomes, Australia builds the infrastructure that it needs, and the government achieves its policy objectives. That is true alignment. But the challenge is making sure that governments create investment opportunities attractive enough that super funds and other private capital choose Australia because the economics stack up, not because they're asked to.
The role of government isn't to direct capital, it's to create the conditions that attract it.
Exactly right.
Tracey, that brings us to another recent policy decision, one that also changes incentives. The May budget contains significant changes to the taxation of capital gains. So how do you think this will change how Australians choose to invest?
Well, one of the things economists often say is that every tax system creates incentives. And whenever incentives change, capital follows. Before we even talk about the reforms themselves, though, it's worth appreciating their scale. The Reserve Bank estimates that around 1 in 10 working age Australians owns an investment property. Even more interestingly, around 30% of those investors own more than one property. And collectively, they own around half of Australia's investment housing stock. So this isn't a niche policy. It has the potential to influence the behaviour of millions of Australians and redirect billions of dollars of capital over time. For almost 30 years, Australia's tax system has strongly rewarded capital growth. The capital gains tax discount encouraged investors to buy quality assets, hold them for the long term, and accept lower income today in exchange for capital appreciation tomorrow. That shaped behaviour across investment property, shares, venture capital, private equity, all risk assets. The budget changes that equation. Now, I don't think growth investing suddenly becomes unattractive in Australia. Great businesses will always create wealth. But I do think the relative attractiveness of different types of investments changes. Superannuation becomes relatively more attractive, for example. If capital gains outside super become less tax efficient, while the tax treatment inside super remains unchanged, then the incentive to own long duration growth assets inside the super system becomes even stronger. Conversely, investments generating reliable income become relatively more attractive outside super. The other implication relates to housing. Investment property has traditionally been purchased by investors. If the after-tax return becomes less attractive, some investors may simply decide not to buy the next property. And so the important question then becomes, who replaces them? If today's seller is an investor, but tomorrow's investor is less willing to buy because the incentives have changed, then the market increasingly relies on owner-occupiers to absorb that stock. Now, owner-occupiers don't necessarily value investment properties in the same way that investors do. They often have different budgets, different preferences, and different objectives. It's the marginal buyer who ultimately determines price. And if a meaningful proportion of investor demand disappears and isn't replaced by owner-occupiers willing to pay today's prices, then prices may need to adjust down until a new marginal buyer emerges, until the market clears. So prices fall.
If fewer investors purchase rental properties, there's also the possibility that rental supply becomes tighter, placing further upward pressure on rents.
That's entirely possible. But perhaps the implication I find most interesting is what it potentially means for Australia's long-term productivity. Growth companies don't usually pay high dividends. They consume capital before they generate it. Australia has always needed patient investors willing to accept lower income today in exchange for future capital growth tomorrow. If we reduce the relative after-tax reward for long-term capital appreciation outside super, do we make it just a little harder for Australian investors to back the next generation of innovative businesses? And tax policy doesn't just influence what investors buy, it influences what gets funded.
So we spent the last 2 weeks talking about nation building, AI, infrastructure and productivity. Sounds like all of those conversations are really about one thing. That's capital allocation.
There is no question. Every tax change, every regulation, every policy reform changes where capital flows at the margin. If Australia wants more investment in housing, AI, infrastructure, innovative businesses, then our policy settings need to encourage that investment. Ultimately, productivity isn't just determined by technology. It's determined by where a nation's savings are invested. And perhaps, that's the question we should ask of every major policy reform. Does it encourage more productive investment into Australia or less? Because in the end, that's what will determine not just the returns investors earn, but it will also determine the kind of economy Australia builds over the next decade.
See, listening to everything we've discussed over the past few weeks, feels like all roads lead back to one issue. It's productivity.
I think that's absolutely right, Ed. We've spent a lot of time talking about AI and housing and superannuation and tax and nation building, but they're all really part of that same conversation. Australia's biggest long-term economic challenge isn't inflation, it's productivity. Inflation is the symptom. Productivity is the cure. The government wants more housing. They want more AI capability, more electricity networks, etc., greater sovereign capability. Every one of those ambitions requires private capital. The challenge is making sure that capital expands the productive capacity of the economy rather than simply adding more demand, which is inflationary. Because if productivity doesn't improve, inflation is much more likely to remain higher for longer. And if inflation remains higher for longer, interest rates are more likely to remain higher for longer as well. That's why I think every major policy decision should now be judged against that one simple question. Will this make Australia more productive? We started today's podcast here, Ed, talking about how the market narrative has shifted from growth to inflation. If Australia can get productivity working for it and create the right incentives for private capital to invest in productivity enhancing projects, then perhaps the narrative will shift again. Instead of asking whether inflation will keep interest rates high for longer, investors can start asking where the next phase of sustainable growth will come from.
Really the sweet spot for an economy. Strong productivity, sustainable growth and lower inflation. They're the conditions that allow central banks to lower interest rates, for businesses to invest with confidence and living standards to improve. Sure, most Australians would vote for that combination any day of the week. Well, thanks, Tracey. That's all we have time for today. Hope that everyone enjoyed the update. We look forward to you joining us for the next podcast. Till then, please take care and stay safe. Thank you.
Thank you for listening to Escala Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorised representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.